Hello and welcome back to the Dukascopy TV studio here in Geneva. Today I'm joined by Dukascopy regular Mourtaza Asad-Syed. Welcome back, Mourtaza. So today we're looking at what you've called the decade of the US. So we're stepping back and looking at the US from like a larger perspective. So looking at the bigger picture, are we likely to see persevering economic growth in the US? And if we are, what can you attribute to this?
I think starting from earlier this decade, in 2011 especially, I think the US really embraced a new set of growth path, very comparable to what we had in the 90s or even in the 80s. I think the patch from 2009 to 2011 was mostly a post-crisis readjustment, but really starting from 2011, we really have the US re-emerging as a internal growth story, with productivity gains, technological changes, large improvement in the job market, which are not seen in the numbers, but if you look at the numbers historically, every day, every month, they've been revised in the past. So it's been years we've been discussing this. Is that the non-farm payroll numbers are very, very reliable, and they underestimate what is really the driving employment force in the US. And now we reach a path of 250,000 job creation every month, and I think it's still underestimated what is really happening in the US. And also, it's very likely we'll revise all the 3 previous years of job creation. So it's a story about the US going back to a growth cycle. A growth cycle in the US lasts about 5 to 6 years. So if you make the starting point in 2011, you will have a growth path of a growth story up till 2017, which would be midpoint of the growth cycle, which means that for the whole decade, it's very likely we'll have more of US growth. We have more of US outperforming the rest of the OECD. We have more about the US surprising economists when they talk about secular stagnation. Secular stagnation is true for Europe, it's true for Japan. It's not yet true for the US, mostly for demographic reason. I think we had an interview on demographics and we saw clearly that it's very age dependent, and the US is still a young country, not about 40 years old on the median age. And 40 years old is really the median age when you enter in secular stagnation. So the US has nothing to do with secular stagnation right now. So it has, I think, in my view, a full decade of still growth, of still a very steady growth path. And so there is a couple of reasons. One reason, this is the fact, this is what we see, it's happening. Why? One is there is a lot of unused capacity since the crisis. Even in 2011, the output gap was half closed, but there is more to go. So it's normal to have a growth that is above average on a growth rate, because you're just catching up to a level where you should be. But this is going to fade. Especially, I think in 2015, we'll reach really full potential, and then we'll have a growth path of 2.5% real growth afterwards. And also there is, I'll mention demographics, but also there is technical changes. What we saw about the internet, about technology, about digitalization often happen in the financial markets, in the media, before it really happens in the real economy. You have, when technology enters the real economy, you have job displacement, and this takes about 5 to 10 years. So we are in the period where you have major technological changes in large employer sector like healthcare and education. And I think there is a new change in education, for instance, in the US, creating a lot of productivity that we don't see other countries. And it's not very visible, but then it really moves the market. And then, of course, there is an energy revolution that everybody's talking about, which is bringing cheap energy. But I think this is a boost, but it's not a driver of growth. This is just a boost, and the driver is how you displace jobs, how you create new jobs, new higher value-added jobs. And I think the US is clearly on this path from the technological advances it has generated over the last 15 years.
Great. You've just touched on cheap energy there, so that brings us straight into the next question with looking to the recent drop in oil prices. So what role do you think commodities will play within the next decade, and will this have any effect on the US?
I think commodities has been at a turning point. It's too late to say it's a turning point. It has turned. Clearly, we had 2000 to 2008, or even 2000 to 2011, we had a pretty nice commodity bull market for 10 years, a decade of revaluation of commodity producer, commodity linked to energy, and financial flows from OECD country, consumer of energy, towards producer of energy. This was a major shift, and this tend to weaken the dollar because most of the energy users are Americans, and they're spending dollars to Middle Eastern and Russians, and those regions are mostly buying euros to recycle dollars, either in imported goods or in assets. So this is reverse. So this is the first impact in the US. It's immediate. It's really happened already. Is that the financial flows of this price has been totally reversed. Now, Russians are looking for dollars, and they don't receive dollars as they used to, so they are not able to sell it. On the contrary, they're buying it, so it reinforces the value of the dollar. And same thing for Middle Eastern countries. They don't receive as much dollar as they used to, which means that they don't spend as much as they used to on European imported goods. So they are less willing to buy euros. Also, this is also a driver of weakening the euro. For the US, this capital flow shows that, or at least we see that it's strengthening the dollar, but more importantly, this race to get dollars, to get safe asset in dollars, makes the cost of financing in the US very, very cheap. Because the rest of the world, emerging markets, they don't have dollars. And when they have assets, they try to have safe assets, which is the US Treasury. So this financial flows is totally reversed. Now people are trying to put their money in dollars and buying the dollars and buying US assets. This has, of course, an economic impact for the US, which is they have a great financing, very cheap financing. They don't care about the value of the dollar. This is very important. The US is a closed economy. It cannot care less about the value of the dollar. Being strong or not, it really doesn't matter, because most of the goods they buy it in dollars anyway, so that's fine. They don't care about the value of the euro and the dollar. Only Europeans could care about it. What they care is interest rates, and interest rates are going down, incredibly going down, and there is no deflation in the US. So in fact, it's really the real rate of finance or cost of financing that is going down, being negative, and it's providing a huge boost for the US. And I think this is the major impact on the US. Cheap energy is nice, but as I mentioned, it's a boost. And then it's not an energy, it's not a manufacturing, giant manufacturing country, the US. It's just regenerating, but it's not huge manufacturing. It's not Germany, it's much lower. So it's nice, but it's not going to change the world. What is changing the world in the US is the financing of debt, and the whole US, the corporate sector, is re-leveraging at a very cheap cost, which means that they can do capex for pretty much free. They can do investment, they can do buyback, they can do M&A, they can do even purchase of foreign assets at a very cheap price with a very strong dollars. So for the US, it's sort of it's a free lunch. The rest of the world is really offering the US a free lunch for the US to spend a lot, invest a lot at a very, very discounted price. So I think it is very significant. The drop of commodities and the trouble there is in emerging market right now is very supportive for the US economy, being a very financial driven economy.
And so how will this economic and political backdrop translate into asset prices, asset allocation and attractive investments?
So I think it's on a 2-3 years trend, it's still safe to bet on the US assets, because I think the numbers will show up as quite strong. The Fed could normalize monetary policy, but the big story is the dollar. Will the dollar continue to strengthen? Everything makes sense for the dollars to strengthen, as I mentioned, the trouble everywhere and the fact that the US economy is going to outperform. The issue is this is mostly priced by the market. Everybody is expecting an increase in the dollar. So when everybody is expecting something, it means that it's already in the price. So we can have an overshoot, but that would be a sentiment-driven overshoot. I think that I would be cautious about being long dollar for the year. I would still like US assets, but there is always a reaction to a trend. The trend has been quite strong, especially last year, with outperformance of the US, following an outperformance of the US. So I would be tempted that there would be maybe a sort of a reaction of other assets balancing out the outperformance of the US. I still think the US equities, or let's say equities in the global world, is a good bet. I would be cautious in being long energy. I think I would rather go gold instead of energy. And to finish, what could really contract the strength of the dollar is, as I mentioned, Americans would be very likely to buy foreign assets because they will take advantage of the strong dollar. So it's very likely, if you find the right quality asset in Europe that would be very complementary to some asset in the US that are very likely to be purchased on M&A, I think there is good potential here. Last year was a big year of buyback, so US company buy back their own shares. This year it's very likely US company will buy others country equities. Like, being a takeover from the US. So you have to find out who could be a potential takeover, but this is very supportive for foreign markets.
Thanks, Mourtaza. That's been great to speak that through with you. Going to be an interesting decade for the US, to say the least. That's all for Mourtaza and myself. Thanks for tuning in, and remember to clicking back to the Dukascopy TV for regular interviews and exclusive updates.